Next up, we've got, unfortunately, due to COVID restrictions, we've had to have our next speaker coming in via video. So let's welcome Alex Tapscott.
Hi, my name's Alex Tapscott, and I'm delighted to be joining you here today remotely, coming in from Toronto, Canada. It's 5 below outside. I sure wish I were in Miami, but at least it's good to be presenting to you this way today. I'm going to spend a little bit of time telling you briefly about why I think blockchain is such a big deal. And from there, I'm going to discuss some of the big trends that we'll be watching for in 2022. So we're at this beginning of a new era of digital progress, often referred to as the second digital age. Now, there are lots of new technologies that have come around that I think are very disruptive and will continue to be, everything from autonomous vehicles to virtual reality and new sources of energy. But there's one in particular that's likely to have a greater impact than any other, and it's called blockchain. It's my firm conviction that blockchain represents nothing short of a new era of the internet and is likely to have as great, if not a greater impact than the first era. Let me explain what I mean by that. You see, when we use the internet today to send and move and access information, we're not actually sending an original, unique thing. We're sending a version or a copy. Now, that's just fine if we're talking about information that can be copied, like, say, I don't know, an email or PDF. And in fact, it's one of the big benefits of the internet. It's sort of like we have our own printing press for information. But when it comes to things that have value, assets that require scarcity, things like money, stocks and bonds, titles and deeds, virtual goods, and so forth, being able to send copies is not such a good idea. And this is a very specific computer science problem that smart people tried to figure out during the first era of the internet. How do you ensure that when you move something of value, that you aren't leaving behind a digital trail of breadcrumbs that you can send a copy? You see, it's great for us all to have a printing press for information, but it's not so great for everyone to have a printing press for assets. And because it was such a difficult problem to solve, through the first era of the internet, what is now commonly referred to as the Web 1 and Web 2 era, we had to rely on intermediaries, middlemen, to sit in the center of transactions and perform some necessary steps. The first thing they did was establish the identity of parties and transactions. From there, they performed all the business logic, clearing, settling, contracting, and record keeping. Really, they were there to create trust. Now, traditionally, intermediaries are banks and other financial services firms. But through the first and second era of the internet, we had to rely increasingly on big social media companies and other technology giants, to the point where the largest corporations of the digital age are not banks and industrial conglomerates. They are digital conglomerates and social media companies. Now, these middlemen have done an okay job, I suppose, but they have some very specific limitations. They're centralized, which makes them vulnerable to attack or to hacking. They add friction and cost to transactions online. They exclude big parts of the population who are unbanked or lack access to an internet connection. And they extract data from users, which is problematic because it means it could undermine our privacy if it ends up in the wrong hands, or it could be used against us. And worst of all, I think, it means that we can't fully monetize the potential. You know, Facebook, these other big social media companies are worth hundreds of billions, trillions of dollars, and they're built on a mountain, an empire of user information. We create it, but we don't get to monetize it. So what if the internet, we're entering a new era, from an internet of information to an internet of value? Well, in 2008, a long time ago it seems like, an anonymous person or persons named Satoshi Nakamoto developed this thing called Bitcoin. Bitcoin was designed to do something relatively simple. It was designed to be cash for the internet, a way to solve the double spend problem by creating a scarce monetary unit that could be moved peer-to-peer without the need for an intermediary, where trust was not established by a third party, but through a combination of consensus and clever code and a lot of computing power as it happens. And what was really amazing about Bitcoin was that it worked. And it's worked so well that it has set off this spark that has caught on like wildfire and spread to almost every industry in the world. It turns out that what makes Bitcoin work can actually apply to every other asset in the economy. And as a result, can allow us finally to rethink the model of how we create value in the world. So I think a lot of people are focused on the price of assets and whether they go up or go down, whether or not that's a good reflection of the underlying usefulness or adoption. And certainly the beginning of 2022 has been volatile. And I think a lot of people, aren't really seeing the big picture. It sort of reminds me of this analogy of the blind men and the elephant, where a bunch of men who are blindfolded or blind are groping at a different part of an elephant. And one touches the body and says it feels like the bark of a tree, and the other one touches the tail, says it feels like a rope, and so on and so forth. If you're too narrowly focused on any one single thing, whether it's a certain crypto asset or prices in general, you're going to miss the bigger picture. So what we're going to do today is just take a step back and remove that blindfold and try to grasp the bigger meaning of what's going on. So a lot of people ask me, well, I get the value proposition for Bitcoin, a way to move money peer-to-peer without an intermediary, a form of savings, a store of value that's not connected to a government, digital gold, maybe some sort of monetary layer that eventually could be widely adopted. But why do we need thousands of coins? Why are there all these cryptocurrencies? And I tell them, you're right. There isn't really a demand for a million different Bitcoin imitators. There should really only be one. And Bitcoin has, I think, solidified its role as a store of value and sort of the monetary unit for this new digital economy. What's important is that many of these other crypto assets really have nothing to do with Bitcoin or even the utility of being a currency. What is Beeple's 5,000 Days, a major work of contemporary art have to do with Bitcoin? Nothing, right? So that's an NFT, that's a different kind of asset. What does a stablecoin backed by US dollars, a fiat currency, have to do with cryptocurrencies? Well, nothing, really. So there are actually at least nine different categories of digital assets, and each of one of these has an important role to play in the digital economy of the future. Now, I'd love to discuss Web3 in general and what I see happening over many different industries, but unfortunately we don't have time for that. So I'm going to focus on one in particular, and I come at it honestly. I used to work in investment banking for many years and still work in the financial industry today. And so I have a first row seat, or at least I have for over a decade, at just how dysfunctional the industry is, how its inner workings are complex and contradictory and antiquated. And it reminds me of this sort of image here, which, if people don't know, is a Rube Goldberg machine. It's basically this apparatus that performs a bunch of kind of silly and unnecessary steps, and in the end it does something very simple, like it cracks an egg or closes a door. This is basically the way the financial industry works today, right? If you tap your card at the card reader at Starbucks, you might think a form of digital currency is moving to the merchant instantaneously, peer-to-peer. But of course that's not true. That transaction is touching your bank and its own ledger, the merchant's bank and its own ledger. It's probably going through a payment network in addition to a credit card issuing company, plus maybe a risk check. And if I were in Miami as a Canadian, hello there, then it would probably be going through some sort of foreign exchange transaction as well. So that transaction is going to touch 7 or 8 different parties before it hits the merchant days later, and with a 2% fee or more to boot. And this is true across every aspect of the financial industry, even how we clear and settle trades and securities. We can buy and sell crypto assets instantaneously, peer-to-peer or peer-to-contract through DeFi or through centralized exchanges. But when it comes to buying shares in a company, we've got brokers and clearinghouses and transfer agents, and we've got exchanges and all these other intermediaries which stand in the way. So this is an industry that is absolutely ripe for huge transformational disruption. And that's really exciting because the first era of the internet, Web 1 and Web 2, really did transform information industries. How we consume the news, how we watch TV, how we search for information is radically different than it was in the 90s. But how we interact with financial services is largely the same. A lot of people ask me, is DeFi just another fintech? And I tell them, no, it's not. Fintech is a new user interface. It is a way to access financial services that is, a bit easier to use and a bit more approachable and maybe a bit sleeker. In many respects, it's sort of like digital wallpaper, right? We've got this old edifice of the financial industry made up of banks and central banks and old technology that they run. But hey, you can access your bank account through a mobile app. That's fintech. DeFi is reimagining the whole structure. We're not talking about a fresh coat of paint or some new digital wallpaper. We're talking about rethinking and rebuilding the industry from the ground up based on first principles, not on how we're going to interact with intermediaries, but what those intermediaries do in the economy and how we might replace them. They do lending, they provide access to growth capital, they insure against risk and so forth. So these are the first principles that DeFi is looking to reimagine from the ground up. And so far, they have had what we would call product market fit. DeFi is likely one of the fastest growing industries ever. The number of daily active users and total users continues to grow at an impressive clip. Even more impressive is the total value that is locked in DeFi protocols. So we're talking 250 billion US dollars as of the last count, which is, albeit not a big number if you're comparing it to the assets of BlackRock or Vanguard or to the assets of a bank like JP Morgan. But it's pretty impressive considering that we started from a basis of basically zero 2 years ago and only $25 billion at the beginning of last year. Stablecoins, though not all related to DeFi, have helped to fuel its growth, and increasingly a lot of the growth in stablecoin supply is actually coming from decentralized or algorithmic stablecoins, things like DAI and UST. And this is a dollar value that today at $165 billion would mean that there's more crypto versions of US dollars in total value than there are in a lot of traditional fiat currencies. I would be shocked if this number doesn't quadruple or more again in 2022. Related to, but not directly under the DeFi umbrella, are NFTs. If Bitcoin is a way to move money peer-to-peer, if Bitcoins are mostly fungible in the sense that one Bitcoin can be interchangeable with the next, and you generally don't care which Bitcoins you receive, then NFTs are different, right? They're totally unique digital goods, and so therefore they're super useful for things like collectibles, for artwork, and for other things that are not duplicative, right? That are unique in some form or another. And as we've seen, 2021 was sort of the year where NFTs had their big bang moment. Everyone was kind of, I think, overwhelmed in March of 2021 when NFT volumes surpassed $500 million. But of course, in comparison to what we saw in the latter half of the year, that looked like a blip on the radar. And what's revealing is that even though crypto markets have been volatile to start the year, NFT values are on track in January to surpass their highest month of last year. We in DeFi, there's a way in which pools can scale called yield farming. Basically, you get paid a yield for helping to bootstrap a network, whether it's providing liquidity to an exchange or providing liquidity to a lending pool. Well, one of the sort of big growth hacks for DeFi was actually in the gamification of crypto, and it's early yet, but the growth in Axie Infinity suggests that play-to-earn games are going to be one of the dominant narratives for this year, I should say. And one other thing here that I think is worth mentioning is that at the beginning of 2021, Ethereum was responsible for about 100%, 99 I think, of DeFi total value locked. So, of all the pools and all the projects, Ethereum was basically the dominant platform. By the end of the year, it was under 70%. Now, does that mean Ethereum's losing relevance? Not necessarily. What it means is that there is tremendous demand for block space, for computing potential on blockchains at the application level, and so people are going to whatever platform they can find. It's my belief that layer ones will continue to thrive, and that we'll probably need a lot more of them and every other kind of scaling solution, including interoperability and things that help us connect the multi-chain. And then, this is either a good sign or a worrying sign that we're near the top. I, for one, think that it's a sign that there is a lot of capital on the sidelines. VC is usually the sharp end of the spear for money that is going after a certain asset class or certain new technology. And as we saw in 2021, VC investment records absolutely smashed all previous years. So what's going on here? Why are all these numbers going up and to the right? Well, I think it's because this industry, which has been basically untouched by technology, is undergoing one of the most radical changes since the invention of double entry bookkeeping in the Middle Ages. Every single function of the industry, from how we store value to how we move value, to how we access credit, to how we get access to growth capital, to how we exchange financial assets, to how we insure against risk and organize financial information and even establish identity, are all being transformed fundamentally by this technology. And in the next few minutes, I'm going to describe some of the more exciting areas. So storing value. Well, for most of human history, we've relied on banks.
All right.